Have you ever chased a breakout, only to watch price reverse and stop you out? You waited. You believed in the breakout or trend continuation and decided to sell at resistance or order block, but the market and smart money had other plans. What if I told you that fake breakout wasn't a mistake? It was the real opportunity. Welcome to the Turtle Soup Strategy, a counterintuitive, sniper-level approach that flips market traps into profit setups. This is your ultimate masterclass. Let's break it all down. In this video, we're going to learn what the Turtle Soup Strategy is, explore the concept behind it, and walk through a step-by-step guide on how to trade the Turtle Soup Strategy effectively. We'll also cover its key variations, how to identify valid trading zones, how to spot high-probability Turtle Soup setups, and review live examples to bring it all together. So stay tuned. This video is highly recommended. Before we dive into setups and entries, let's understand what the Turtle Soup Strategy really is. The Turtle Soup Strategy is a reversal setup that targets failed breakouts of previous swing highs or lows. The idea? When price breaks a major high or low and then quickly reverses, it signals a liquidity trap. This strategy catches that trap and profits from the reversal. What is the concept behind this and why does this work? Because breakouts attract attention. They trigger stop losses, breakout orders, and emotional trades. And that means one thing: liquidity. Smart money uses that liquidity to enter trades in the opposite direction. The Turtle Soup Strategy isn't about following the crowd. It's about patiently waiting for the crowd to get trapped, then taking the other side of the trade. Let's explore two powerful forms this strategy can take. Starting with the major trend reversal. Imagine a market trending upward. It pushes higher, forms a small consolidation, then breaks above the previous swing high. Retail traders get excited. They expect continuation, but the next candle closes back inside the range. This is a classic trap. The breakout fails, and now the setup for a powerful reversal is in place. Now let's flip the context and look at a minor trend reversal within a major trend continuation. The market is in a healthy uptrend. It pulls back and takes out the most recent swing low. Retail traders panic, thinking the uptrend is breaking, but price immediately reclaims that swing low with a strong bullish candle. This isn't a reversal of the overall trend. It's a continuation setup using the Turtle Soup concept to fake out weak hands before launching higher. Both situations revolve around one principle: liquidity traps, and both can be traded with the same core framework. Every valid Turtle Soup setup operates inside a defined range. That range is crucial. It's what tells us whether the fake-out is happening in the right context. Think of this range as having two zones. At the top, above the 50% mark, is the premium zone. This is where we hunt for sell setups, especially when price breaks above and then closes back inside. At the bottom, below the 50% mark, is the discount zone. This is where we look for buy setups, when price sweeps below structure and snaps back in. Identifying whether price is in the premium or discount zone helps filter weak setups from strong ones. Avoid taking trades at the equilibrium of the range. Moving on. Let's walk through how to actually trade the Turtle Soup Strategy, step by step. Start by identifying a 20-day range, high and low, or a swing high and swing low. Often, this comes after a trending move, followed by minor consolidation. Now wait for the breakout. This is where the trap sets. Price must break above the swing high or below the swing low, but don't enter yet. This is where most traders are trapped. They think price will break, retrace slightly to test support or an order block, and then keep running. But Turtle Soup assumes the opposite, that this breakout is bait. Next, look for a strong rejection. You want price to close back inside the range. That rejection is your trigger. There are two major variations of the Turtle Soup rejection pattern. Turtle Soup +1. This is a conservative method of trading the Turtle Soup pattern, as the liquidity sweep and entry take place within two candles. Here's how it goes. Price breaks a key liquidity level and either closes beyond the range or back inside the range. Then, you wait for a second confirmation candle, which closes firmly inside the range. This signals momentum. For example, a strong engulfing candlestick or a high-volume rejection candle. This adds an extra layer of confirmation. You can enter on the close of the confirmation candlestick or wait for a slight retracement to reduce your risk. This gives you a tighter stop loss and a better risk-to-reward ratio. Your stop loss goes just beyond the fake-out's candlestick, and your first profit target is typically the opposite end of the range or a 2-to-1 risk-to-reward. Then there's the classic Turtle Soup. This is an aggressive method of trading the Turtle Soup strategy, where the liquidity sweep and entry occur within the same candlestick. You can either enter on the close of the rejection candle, especially if it's a strong reversal candlestick pattern like a pin bar, or enter as soon as price starts rejecting the level. In this case, you can look for entry confirmation on a lower time frame, using either a change of character for a refined entry or strong candlestick reversal patterns. The same stop-loss principle applies, the same targets as well. Both entry methods work. Choose based on your risk appetite, chart clarity, and the current volatility. Next, how do we identify or mark out these ranges? In order to mark a valid turtle soup range, we need to define clear and significant levels. Here's a list of range types and the time frames they can be effectively traded on. A 20-day high or low can be traded on the daily chart. A swing high or swing low can be traded on all time frames. Market sessions, such as Tokyo, London, and New York, can be traded on the M5 to H1 time frames. Equal highs and lows, supply or demand zones, psychological levels, and Fibonacci levels can be traded on the M15 to H4 time frames. The previous day's high or low is valid for intraday setups. Monthly and weekly highs and lows can be traded on the H1 to daily time frames. The time frame you choose depends on your trading style. Swing traders typically focus on the daily and 4-hour charts. Intraday traders tend to go down to the 1-hour and 15-minute charts. The key is this: the level must be obvious and clean, something that many traders can clearly see as a breakout point, because that's what draws in liquidity. And that's exactly what the turtle soup strategy feeds on. Before we continue, please don't forget to subscribe and like so we can keep creating more educational videos. So, how do we identify high probability setups? It starts by adding strong confluences to increase the quality of every trade being taken. The first method is integration with indicators, such as RSI divergence, MACD divergence, and volume analysis. For this video, we'll focus on RSI divergence. Take EURUSD on the 4-hour chart as an example. The market is trending bullish. We begin by identifying and marking out the most recent swing high and swing low as our range of interest. Now, observe price action. Price breaks below the swing low, closes below it, and then forms a bullish engulfing candle that closes back inside the range. But here's the key. While price made a lower low, the RSI indicator formed a higher low. That's bullish divergence. It indicates that the breakout lacked real momentum. This confluence makes the turtle soup setup significantly more reliable. Entry can be made on the close of the bullish engulfing candlestick, if your risk management allows. If not, place a buy limit order at 50% of the confirmation candlestick, with your stop loss a few pips below its low. Your target should be the next key level or prior structure high. Next, integration with key market zones such as fair value gaps, order blocks, and supply or demand zones, still using the same bullish EURUSD chart for our second example. After marking out our swing high and swing low, we identify and mark key zones near our range of interest. In this case, we spot a fair value gap just below the swing low and an order block directly beneath it. Price then breaks the swing low, sweeping all the stop losses placed beneath it, and in the process, mitigates the fair value gap. This confluence adds significant strength to the setup, and price immediately reverses back inside the range. At this point, you now have liquidity imbalance and institutional intent all lining up. Entry is made on the close of the rejection candle, and your stop loss is placed just below its low. Profit targets should be multi-tiered, first at the range midpoint, then at the opposing swing level. Finally, integration with volatility and timing. Timing matters. The best turtle soup setups often occur during high volatility trading sessions, specifically the London Open and the New York Open. This is when most breakouts occur, and it's also when the majority of market traps are laid. So when you combine all three, indicator divergence, key zone mitigation, and session volatility, you have a truly high probability turtle soup trade. Let's look at a live example. On the EUR-USD 1-hour time frame, just a few hours before the New York Open, the market is clearly bullish but currently consolidating. So we begin by marking out the last major swing high and swing low as our range of interest. Retail traders are expecting price to mitigate the last order block that led to the break of structure and continue its bullish sentiment. But as a turtle soup trader, we anticipate that price will instead sweep that order block. Looking closely at our range, we can see that price is currently sitting within the discount zone. Therefore, we're only looking for buying opportunities. Next, we identify and mark out key zones that are close to our range of interest. Looking to the left, we spot a demand zone, In situations where you have a candlestick representing demand or supply with a long wick, the wick becomes your point of interest and should be marked. Moving on. Price breaks below our defined range, sweeping the stop losses of retail traders, just below the last major swing low or the order block. It then mitigates the demand zone and strongly rejects it with a bullish engulfing candlestick. Taking a closer look at the RSI indicator, we observed that while price was making a lower low, the RSI was making a higher low. This divergence between price and RSI signals a false bearish intent, adding more confluence to the setup and increasing the overall probability of the trade. Now, because entering immediately would result in a wide stop loss, a buy limit order was placed at 50% of the confirmation candlestick. The stop loss was placed just below that candle. The first profit target was the swing high of the range, and eventually, take profit was reached. The turtle soup strategy isn't about guessing. It's about waiting for the herd to commit, watching them get trapped, then taking the other side with precision and confidence. If you understand how to mark your range, identify liquidity traps, combine smart confluences, and time your execution, you'll not only avoid getting caught in false breakouts, you'll start profiting from them. If this masterclass helped clarify how turtle soup works, watch our other deep dive videos on other topics. They'll sharpen your edge even further. Don't forget to like, subscribe, and drop a comment.